If there is one truth that quietly governs the trading world, it is this. The market does not need to be mastered. You do. Every chart, every price candle, every unexpected spike or sudden collapse is merely a reflection of collective human behavior. But your response to that behavior is shaped entirely by your inner state. Traders search endlessly for certainty in a place where certainty does not exist. They chase predictions, systems, and guarantees, hoping to outrun discomfort, eliminate doubt, and silence the very emotions that make trading feel risky. Yet the real breakthrough begins only when you turn inward and recognize that the only variable you can ever truly control is yourself. Mastering yourself is not about forcing confidence or suppressing fear. It is the process of aligning your mindset with the nature of the market, a fluid, neutral, unpredictable environment where anything can happen at any moment. Most traders enter with expectations that markets should behave according to their plans, their analysis, or their needs. This expectation quietly builds tension, and from tension comes emotional interference, hesitation, revenge trading, premature exits, unrealistic hopes, or paralysis after a loss. The moment your expectations override your acceptance of market uncertainty, you disconnect from true trading performance. To master yourself, you must begin to understand how your beliefs shape your experience. Every belief about winning, losing, money, worth, and risk influences the decisions you make in milliseconds, decisions that feel rational but are often driven by old emotional patterns. The trader who believes losses are personal failures will always struggle to execute consistently. The trader who believes that risk is a threat rather than a tool will always hesitate. And the trader who secretly hopes the market will reward flawed behavior will eventually encounter the same painful lessons again and again. Self-mastery demands a shift in how you interpret market information. You must train yourself to see price movement not as confirmation or threat, but as data, nothing more, nothing less. When you no longer attach emotional significance to each tick, you begin to trade with clarity. You stop fighting the market and start flowing with it. This is the mindset that allows you to act effortlessly, without fear, pressure, or internal conflict. True mastery also requires radical responsibility. Every outcome, a gain, a loss, or a missed opportunity, is the product of your choices, not the market's unfairness, not another trader's manipulation, not the news. When you accept full responsibility, you reclaim your power. You stop searching for external reasons to justify internal discomfort, and you begin using each trade as feedback about your mental state. In the end, mastering the market is an illusion. The goal is to master the impulses, beliefs, and emotions that distort your perception of it. When your internal environment becomes calm, objective, and fully aligned with risk, probability, and uncertainty, the external environment, no matter how volatile, stops feeling hostile. It becomes navigable. It becomes structured. It becomes an opportunity, not a threat. Accepting market uncertainty without emotional resistance begins with understanding that the market is a constantly shifting environment where no single outcome is ever guaranteed. Most traders intellectually acknowledge this truth, but emotionally they fight it. They want certainty, predictability, comfort, and reassurance in a place that offers none of these things. This creates an inner conflict that quietly sabotages decision-making. Accepting uncertainty means dissolving that conflict. It means recognizing that every moment in the market is unique, formed by countless visible and invisible forces, and no amount of analysis can fully capture or control what those forces will do next. When you stop expecting the market to behave according to your projections, your emotional reactions begin to loosen their grip. Emotional resistance to uncertainty typically shows up as fear, hesitation, frustration, and the urge to control outcomes. These reactions come from the belief that uncertainty is dangerous. But uncertainty itself is neutral. It's simply the natural condition of the market. The danger comes not from the uncertainty, but from the way a trader interprets it. If you believe uncertainty means you could lose, fail, be wrong, or be judged, then every price movement feels personal. You begin to interpret market behavior as a response to your actions rather than the collective actions of millions of participants. This faulty connection between self-worth and market movement is what creates emotional turbulence. To truly accept uncertainty, you must train yourself to separate who you are from what the market does. The market does not reward you for being prepared, nor does it punish you for missing an opportunity. It simply expresses the behavior of the crowd. When you internalize this, you stop reacting to the market as if it were a reflection of your skill or identity. You start viewing each outcome as one event in a larger series of probabilities. This shift in perspective is essential because emotional resistance is usually triggered when expectations and reality collide. If you expect the market to follow your prediction and it doesn't, the emotional discomfort is immediate. But if you expect uncertainty itself, you are no longer surprised or threatened by outcomes you didn't anticipate. Accepting uncertainty also means letting go of the illusion of control. Traders often believe that more analysis, more indicators, or more information will give them certainty, but the pursuit of perfect clarity often creates confusion and hesitation. The more you try to avoid uncertainty, the more overwhelmed you become. True confidence comes not from knowing what will happen next, but from knowing that whatever happens, you can respond without emotional interference. This is the core of psychological mastery. When you trust your ability to act despite the unknown, uncertainty stops being something to fear. It becomes an ordinary part of the trading environment. Emotional resistance often appears strongest after losses. Losses activate fear, self-doubt, and the instinct to protect yourself from further harm. This emotional pattern leads to hesitation, premature exits, revenge trading, or shrinking your position size at the wrong times. But when you truly accept uncertainty, you stop seeing losses as something gone wrong. You begin to understand that losses are natural, unavoidable, and statistically expected. Every trading strategy, no matter how effective, has losing trades. The difference between a trader who accepts uncertainty and one who resists it is how they interpret those losses. Someone who accepts uncertainty sees losses as part of a sequence. Someone who resists uncertainty interprets losses emotionally as threats, failures, or punishments. This emotional interpretation makes it much harder to stay consistent. Another layer of acceptance involves adjusting your expectations from trade-by-trade outcomes to long-term performance. When you fixate on each individual trade, uncertainty feels overwhelming because every trade feels like a test. But when you shift your focus to the next 100 trades, the emotional weight of each outcome becomes smaller. You begin to see that you don't need certainty in any single trade. You only need consistency in how you execute your edge. Uncertainty becomes something you work with instead of something you try to avoid. A trader who accepts uncertainty operates with a mindset rooted in flexibility. They are not attached to being right. They are not shaken when the market moves against them. They are not surprised when volatility rises or when a seemingly perfect setup fails. This flexibility comes from an internal understanding that anything can happen and that the market owes nothing to any individual. When you internalize this fully, you stop fighting the market mentally and emotionally. You stop projecting your expectations onto it. Instead, you observe it as it is, respond to it as it behaves, and make decisions based on probability rather than hope. One of the most powerful effects of accepting uncertainty is the reduction of fear. Fear arises when you perceive a threat. In trading, the threat usually comes from the unknown. But when you make peace with the unknown, the fear fades because there is nothing left to protect yourself from. You begin to operate with a sense of mental neutrality. This neutrality allows you to see opportunities clearly, without distortion from fear or excitement. Your mind becomes steady instead of reactive. And when your mind is steady, your execution becomes precise. Emotional resistance can only exist when there is internal friction between what you expect and what is happening. When you remove the expectation that the market must behave in a certain way, that friction disappears. You begin to accept each moment as it comes without attaching emotional weight to it. This acceptance creates psychological freedom, the freedom to act without hesitation, without fear of loss, without the burden of needing the market to validate you. Accepting market uncertainty without emotional resistance is not a one-time decision, it's a process of conditioning. You must repeatedly remind yourself that uncertainty is not the enemy. You must repeatedly observe your reactions when the market surprises you. You must repeatedly practice responding with neutrality. Over time, your mind adapts. You stop bracing against the unknown. You develop the ability to flow with market movement instead of fighting it internally. In this state, trading becomes clearer, calmer, and far more aligned with the nature of probability. Trading based on probability rather than expectation begins with a fundamental mental shift, recognizing that every trade is nothing more than one event in a long series of events. Most traders approach the market with a hidden desire for the next trade to be special, important, or decisive. They attach expectations to it, expectations about how price should move, where it should reverse, when it should respond, and how far it should go. These expectations create emotional pressure, and emotional pressure leads to distorted perception. When you trade with expectations, you are mentally committing yourself to a specific outcome, even if the market shows something different. This commitment blinds you to the fact that the market does not follow your projections, it only expresses probabilities. A probability-based mindset frees you from this emotional attachment. It means understanding that your edge is not about predicting what will happen next, but about finding situations where the odds are slightly in your favor. A slight edge, repeated consistently, produces long-term profitability. But expectation-based thinking tries to force certainty into a probabilistic environment. When your mind clings to a single outcome, you become vulnerable to fear, frustration, and disappointment whenever the market deviates, even slightly, from what you hoped would happen. Probability-based thinking, on the other hand, allows you to stay mentally flexible because you acknowledge from the start that multiple outcomes are always possible. Trading based on probability also requires you to redefine what it means to be right. In an expectation-driven mindset, being right means the market moves exactly the way you predicted. Anything else feels like failure. But in a probability-based mindset, being right means executing your plan according to your rules, regardless of the outcome. A losing trade can still represent correct execution if it followed your statistical edge. This shift removes the emotional burden of being wrong. You no longer interpret a loss as personal failure or threat to your identity. You interpret it as part of the statistical distribution of your trading method. When you trade with expectations, you are often caught off guard by normal market behavior. You might feel shocked when a reversal happens, angry when a stop loss is hit, or excited when a candle moves in your favor. These emotional spikes come from the belief that the market should follow your desired path. When it doesn't, you experience internal resistance. But when you view the market through probabilities, these events lose their emotional power. A reversal does not shock you because it was always one of the possible outcomes. A stop-loss hit does not anger you because it was built into your plan. Favorable movement does not make you euphoric because it is simply the positive side of your edge unfolding. Trading on probability also enhances discipline. Expectations cause impulse. They make you chase trades, hold losers, abandon rules, or exit prematurely because you are emotionally tied to a specific outcome. But when you commit to probabilities, discipline becomes a natural extension of your mindset. You follow your rules because you understand that consistency strengthens probability. Every rule you violate weakens the reliability of your edge. When you trade probabilistically, you stop focusing on any single trade and instead focus on the integrity of your process. This mindset eliminates the urge to interfere with your system emotionally because you no longer believe that any one trade holds special significance. A probability-based trader respects randomness. They understand that even perfect setups can fail and that poor setups can occasionally succeed. This randomness is not a flaw. It is the nature of the market. Instead of fearing randomness, they incorporate it into their thinking. This allows them to manage risk more effectively. Risk becomes a tool rather than a threat. You size positions according to what you can accept emotionally and financially. You embrace the possibility of loss because you know it is simply the cost of doing business. Expectation-driven traders deny this reality and react emotionally when randomness disrupts their predictions. Probability-driven traders expect randomness and therefore remain steady when it appears. One of the most important aspects of probability-based thinking is maintaining emotional neutrality during trades. Emotional neutrality is not apathy, it is the absence of bias. When you are neutral, you observe price action objectively. You recognize when the market is no longer supporting your thesis and you exit calmly. You recognize when the market is offering a valid setup and you enter without hesitation. Expectation-based thinking clouds your perception. You see what you want to see rather than what is actually happening. Probability-based thinking clarifies your perception. It aligns your decision-making with reality instead of hope. Another advantage of a probability-focused mindset is the ability to adapt quickly. When you expect a specific outcome, you become rigid. You try to force your will onto the market, and rigidity leads to frustration, stubbornness, and error. When you trade with probabilities, adaptation is natural. You shift with the market because you know in advance that no outcome is guaranteed. Flexibility becomes intuitive. You are not disappointed when one path fails because you are ready for the next possibility. This is how consistent traders remain stable in volatile environments. Trading based on probability also sharpens your patience. Expectations create impatience because the mind is fixated on a specific result happening now. But probabilities operate on a larger sample size. When you internalize this, you stop forcing trades. You wait for your edge. You understand that the market will offer endless opportunities, and you do not need to grab every movement. Patience becomes a strength, not a struggle. You wait because you value the integrity of your edge over the illusion of constant action. Perhaps the most profound effect of a probability-driven mindset is the reduction of emotional pain. Pain in trading comes from violated expectations. Expectations about profit, perfection, timing, or certainty. When you release these expectations, pain dissolves. You are no longer emotionally shocked by outcomes. You stop seeing the market as something that acts against you. Instead, you see it as a neutral environment where your edge plays out over time. This neutrality produces calm execution. Calm execution produces consistency. Consistency produces confidence. And confidence, grounded in probabilities rather than predictions, becomes unshakable. Detaching personal identity from wins and losses begins with understanding how deeply the human mind connects achievement, approval, and self-worth. From an early age, people learn to measure themselves by results, grades, performance, recognition, success, or failure. This conditioning becomes so ingrained that when you enter the trading environment, you unconsciously bring the same framework with you. Without realizing it, you treat every trade as a personal test. When you win, you feel validated. When you lose, you feel diminished. The market becomes a mirror you use to judge yourself. But the market is not a mirror, and interpreting it as one creates unnecessary emotional turmoil. The moment your self-worth becomes tied to market outcomes, trading stops being an objective mental process and becomes an emotional struggle. In trading, wins and losses are not reflections of who you are, but reflections of probability and behavior. However, if you attach your identity to the outcome of each trade, you amplify the emotional consequences. A win becomes proof that you are capable, skilled, intelligent, or worthy. A loss becomes proof that you are inadequate or careless. This pattern leads to emotional instability because trading is inherently filled with both winning and losing. No strategy wins all the time. No trader, no matter how experienced, escapes losing trades. When your identity is linked to something inherently uncertain, your emotional state will swing with the randomness of the market. This instability interferes with clear thinking, consistent execution, and the ability to follow your plan. Detaching identity starts with redefining the meaning of a win and a loss. A win is simply an outcome where the market moved favorably within the probability of your edge. A loss is an outcome where the market moved unfavorably within the same probability. Neither outcome is personal. Neither indicates anything about your intelligence, your discipline, your potential, or your worth. They are data points in a larger sequence. When you adopt this perspective, you begin to neutralize the emotional charge around outcomes. Wins stop making you overly confident, and losses stop making you emotional. Your decisions become less impulsive and more aligned with your plan. One of the strongest signs of identity attachment is overreaction. When a trader deeply connects the result of a trade to their sense of self, they experience extreme emotional responses. After a win, they might feel invincible, take excessive risk, or abandon their rules because they feel superior. After a loss, they might feel frustrated, fearful, or defensive, leading to revenge trading or hesitation. These emotional spikes are not reactions to the market, but reactions to the perceived impact on self-worth. When you detach your identity, you eliminate the need to defend your ego. There is nothing to protect when you no longer interpret outcomes personally. You allow the market to unfold without emotional interference. Another key part of detachment is recognizing the difference between self-trust and outcome dependence. Traders who tie identity to results often believe they gain confidence from winning, but this kind of confidence is unstable because it depends on external validation. The moment a loss occurs, confidence collapses. True confidence, the kind that supports consistent decision-making, comes from trusting your process, not your results. It comes from knowing that you executed your plan correctly, regardless of whether the trade won or lost. When your sense of worth and confidence comes from your behavior instead of outcomes, losses lose their emotional sting, and wins stop inflating your ego. Identity attachment also shows up in the way traders interpret mistakes. Traders who take outcomes personally tend to see mistakes as character flaws. They internalize them, replay them mentally, and use them as fuel for self-criticism. This creates fear of failure, and fear of failure leads to hesitation, avoidance, or impulsive decisions meant to escape discomfort. In contrast, traders who do not attach identity to outcomes view mistakes objectively. A mistake is simply a deviation from the plan, not a moral failure. This objective perspective makes learning easier because the mind is not clouded by defensiveness or shame. Detachment creates space for growth. Detaching identity from results also improves risk management. When a trader's self-worth is on the line, they tend to risk too much to protect their ego or chase validation. They may increase position sizes after wins to feel more powerful, or take large trades after losses to recover their sense of competence. But when identity is not tied to profits or losses, risk becomes a strategic choice rather than an emotional one. You set position sizes based on logic, not ego. You accept losses as statistical events rather than personal defeats. This leads to more stable equity curves and calmer decision-making. Another important aspect of detachment is understanding that the market does not know who you are. It does not reward good behavior or punish emotional decisions. It does not care if you are tired, hopeful, angry, or afraid. It does not care about your goals or your needs. When you attach your identity to outcomes, you assume the market is responding to you. This creates illusions of control and illusions of persecution. You might feel the market is against you, or that it owes you because your ego interprets randomness as something personal. Detachment dissolves these illusions. When you stop personalizing outcomes, you stop feeling like the market is a judge. You simply see it for what it is, a neutral environment expressing collective behavior. Detaching your identity also strengthens your ability to execute under pressure. When outcomes do not threaten your sense of self, there is no fear holding you back. You can enter trades decisively because you are not trying to protect your ego from being wrong. You can exit trades logically because you are not trying to preserve an image of success. You become free to act on your plan without emotional interference. This freedom is what separates consistent traders from inconsistent ones. Consistency is not a product of talent, but of emotional neutrality, and emotional neutrality becomes possible only when outcomes are not tied to identity. Another benefit of detachment is resilience. Because trading includes inevitable losses, setbacks, and frustrating moments, traders who link outcomes to identity often collapse after painful periods. They take breaks not to regroup, but to recover their self-worth. They avoid trading out of fear. They question their ability entirely. But those who detach identity can recover quickly because they do not see losses as personal wounds. They see them as statistical occurrences or feedback about their behavior. This resilience allows them to maintain momentum in their learning and refinement. Detachment is not about suppressing emotion. It is about removing emotional meaning. You are not trying to stop yourself from feeling disappointment or excitement. You are training yourself not to interpret those feelings as reflections of your value. You allow emotions to rise and fall naturally without letting them control your behavior. Over time, as you practice this mindset, trading becomes less about proving yourself and more about expressing your edge. The quieter your ego becomes, the clearer your thinking becomes. And the clearer your thinking becomes, the more consistently you can execute in a probabilistic environment where outcomes are never fully certain and never personally meaningful. Responding to price action objectively rather than emotionally begins with recognizing how easily your mind assigns meaning to movement on a chart. Every candle, every spike, every pullback can trigger internal reactions long before you consciously recognize them. These reactions are shaped by past experiences, unmet expectations, hopes, fears, and hidden beliefs about money and risk. When you interpret price action through these emotional filters, you don't see what is actually happening. You see what your mind wants or fears. Objectivity is the ability to see price without those distortions. It means letting the market speak for itself rather than projecting your internal state onto it. Achieving this requires a deliberate shift in how you process information. Objectivity begins with emotional detachment. When you are emotionally invested in a specific outcome, your brain naturally searches for patterns that confirm what you want to be true. This is confirmation bias, and it is one of the most powerful psychological forces in trading. If you want the price to rise, you notice only bullish signals. If you fear a drop, you zero in on bearish signs. Both perceptions distort reality. To respond objectively, you must suspend your expectations long enough to allow the chart to reveal its actual structure. This means focusing on what the market is doing, not what you think it should do. Emotions cloud perception by speeding up or slowing down your interpretation of data. Fear makes the market feel faster and more threatening than it is. Excitement makes it feel slower and more predictable. Both distortions affect timing, entries, and exits. When your emotions control your interpretation, you act too early, too late, or for reasons unrelated to the actual behavior of price. Objectivity is recognizing when these emotional distortions arise and choosing not to act on them. It is maintaining a mental posture that stays steady regardless of whether the last candle was large, erratic, or unexpected. Responding objectively requires that you trust your system more than your impulses. Impulses come from emotion, systems come from structure. A system is built on rules that reflect your tested edge. When you operate from emotion, you override those rules. You enlarge stop losses, shrink targets, chase entries, or hesitate at the moment action is required. When you operate objectively, you follow your rules because you know they represent the logic of your method. You execute not because price feels a certain way, but because your rules dictate action. This creates a layer of protection between your emotions and your decisions. To develop objectivity, you must observe price action as information rather than as a threat or opportunity. A spike is a spike, not a promise. A pullback is a pullback, not a warning. A breakout is a breakout, not a guarantee. When you stop giving emotional meaning to movements, you create space for unbiased analysis. This allows you to see patterns more clearly, identify shifts in momentum without tension, and recognize areas of risk without fear. The more neutral your interpretation becomes, the more precise your decisions become. Objectivity also depends on understanding that price action is often deceptive when viewed through emotion. The market frequently makes moves that appear dramatic but are statistically normal. Emotional traders interpret these moments as signals of danger or opportunity when they are simply part of the natural rhythm of volatility. If you allow emotion to guide your reaction, you will constantly misread these movements. Objective traders expect volatility. They expect sudden spikes. They expect failed breakouts and fakeouts. Because they expect variability, they do not interpret such events as personal attacks or invitations. They interpret them as neutral information that may or may not align with their setup. Another element of objectivity is staying anchored to the present moment. Emotional reactions often come from projecting into the future or replaying the past. If you fear losing, you imagine future pain and react preemptively. If you crave profit, you imagine future gain and hold too long. If you regret a missed trade, you bring that regret into your next decision. Each of these scenarios pulls you away from the only place information is real, the present moment. Objectivity is the discipline of returning your attention to what price is doing right now, not what it did earlier or what you hope it will do next. This presence allows you to read price action in its current context rather than through the lens of past experiences or imagined outcomes. Responding objectively also requires an acceptance of being wrong. When traders fear being wrong, they distort price action to justify staying in losing trades or entering questionable ones. They ignore signs of reversal, rationalize deteriorating conditions, or cling to analysis that no longer applies. Objectivity means allowing price to prove you wrong without resistance. You acknowledge what the market is communicating instead of arguing with it. When price shows your thesis is invalid, you exit. When price supports your edge, you act. This fluid responsiveness is only possible when ego is not involved. A key component of objective interpretation is consistency in how you read market structure. Emotional traders interpret patterns differently depending on their mood or their last trade. A head and shoulders pattern might feel bearish after a loss, but questionable after a win. Objectivity demands that you interpret structure the same way every time. This consistency creates reliability in your analysis and removes emotional variability. You begin to treat patterns as probabilities rather than predictions, which aligns your perception with the true nature of the market. Objectivity is strengthened by predefining your criteria before entering the market. When you know exactly what qualifies as a valid setup and what invalidates it, you reduce the influence of emotion during real-time decision-making. Predefined rules act as anchors. They remind you of your logic when emotions try to pull you into reactive thinking. When you know your entry trigger, your stop placement, and your target structure ahead of time, Price action becomes a series of signals rather than emotional events. You simply observe whether price is meeting your criteria. If it does, you act. If it does not, you wait. One of the most powerful ways to develop objectivity is to reframe price movement as neutral feedback. Every tick provides information about the balance of buyers and sellers. When you see price as feedback instead of fortune or failure, you remove the emotional color from your interpretation. Feedback helps you understand whether your thesis aligns with current conditions. If it does, you stay. If it doesn't, you adjust. The neutrality of feedback keeps your mind calm, which allows you to interpret price with clarity. Objectivity also requires that you protect your mental energy. Emotional reactions drain focus and disrupt your ability to interpret data clearly. If you approach the market tired, stressed, or distracted, your emotional sensitivity increases and your objectivity decreases. A tired mind sees threats where there are none and opportunities where none exist. Maintaining a clear mental state is essential for responding to price action with precision. This means creating routines that support calmness, clarity, and presence before you trade. The more you practice responding to price action objectively, the more you reduce the emotional noise that clouds decision-making. You begin to experience the market as information rather than drama. You stop interpreting movement as good or bad, favorable or threatening. You simply observe what is happening and follow your plan. As emotion decreases, clarity increases. And as clarity increases, your ability to read and respond to price action becomes more aligned with reality and less influenced by internal impulses. Taking full responsibility for every trading decision means stepping out of the mindset that the market owes you something, that someone else caused your loss, or that circumstances outside your control derailed your trade. Responsibility is the anchor of a trader's psychological stability because it eliminates the need to assign blame, justify mistakes, or defend your ego. When you embrace responsibility, you gain the clarity to see your decisions as they truly are, choices made in the moment based on your beliefs, perceptions, and emotional state. This clarity is what allows you to grow, because you can't change what you don't acknowledge and you can't improve what you refuse to own. A trader who avoids responsibility will always feel at the mercy of the market. They'll say the news ruined their trade, the broker manipulated the spreads, liquidity dried up, whales entered, or volatility spiked. Maybe some of those things are true, but none of them remove the responsibility of the decision itself. You chose the entry. You chose the stop placement. You chose the position size. You chose to stay in or exit. Every one of those decisions came from your internal framework, and taking responsibility means examining that framework without defensiveness. It means realizing that even unpredictable events don't excuse emotional reactions, impulsive actions, or the failure to prepare for what reality can throw at you. When you accept this level of ownership, you start seeing losses differently. A loss isn't an attack on your intelligence or proof of your inability. It's simply feedback, a mirror showing you the truth about your execution, mindset, or risk control. Traders who blame external forces don't receive this feedback clearly because their focus is on defending themselves instead of learning from the experience. But traders who take responsibility filter every trade through a different lens. What did I do? What belief drove that choice? What emotion influenced it? What skill was lacking? What preparation was missing? This internal questioning isn't self-criticism, it's self-awareness, and self-awareness is the foundation of consistent profitability. Responsibility also eliminates the emotional roller coaster many traders experience. When you think the market is doing something to you, every loss feels personal, unfair, or painful. You feel wronged instead of reflective. But when you know your decisions created your results, the emotional charge deflates. You begin to see that you are the source of your outcomes, not the victim of them. That shift gives you control, not control over the market, but control over how you interpret, respond, and decide. That's the only control that truly matters in trading. Taking responsibility also means not allowing yourself to celebrate wins in a way that feeds your ego. A profitable trade isn't proof that you've mastered the market or that you're invincible. It's simply evidence that your decision aligned with market movement this time. When you internalize wins too deeply, you set yourself up for overconfidence, risk escalation, and impulsive trading. Responsibility creates balance. You acknowledge the skill in your win, but you also acknowledge the role of probability, timing, and conditions. You remain neutral instead of inflated. grounded instead of reckless. Another dimension of responsibility is preparation. Many traders jump into the market with incomplete analysis, unclear plans, or unstable emotional states, and then blame the outcome on external factors. True responsibility means preparing thoroughly, structuring your analysis, defining your risks, setting your targets, managing your expectations, and being emotionally ready to follow your plan. It means you don't rely on luck, hope, or fear. You rely on a structured process, and when the trade ends, you evaluate how well you followed that process. Responsibility also extends to your beliefs, the invisible rules that shape your trading decisions. Every action comes from a belief about the market, about yourself, about risk, about opportunity, about certainty, about money. If you hold conflicting beliefs, limiting beliefs, or emotionally charged beliefs, they'll interfere with your execution. Taking responsibility means examining these beliefs, understanding where they came from, and consciously choosing the ones that support objectivity, patience, discipline, and probability. You cannot change a belief you refuse to admit exists. Responsibility brings them into the light. A trader who fully accepts responsibility is also willing to confront discomfort. Growth requires confronting your impulses, biases, and emotional triggers. Responsibility forces you to look at your fear of missing out, your desire to be right, your attachment to outcomes, and your tendency to exit too early or too late. It means you stop telling yourself convenient stories and start telling yourself the truth. You stop hiding behind excuses and start confronting your patterns. The market becomes less of a battlefield and more of a classroom. This level of ownership transforms your confidence, not the fragile confidence that comes from winning streaks, but the real confidence that comes from knowing you can trust yourself. You no longer fear losses because you know you can analyze them objectively. You no longer fear volatility because you've prepared for multiple scenarios. You no longer feel the need to control the market because you're focused on controlling your behavior. Responsibility gives you stability because it removes the chaos of blame and replaces it with the structure of understanding. Taking full responsibility also means recognizing that no one is coming to save you. No indicator, no strategy seller, no signal provider, no guru, no algorithm will fix the internal issues you refuse to face. External tools can support your trading, but they cannot replace your psychological discipline. They cannot trade for you. Responsibility means understanding that your profitability will always come from you, your mindset, your decisions, your consistency, your ability to stay aligned with your process. This doesn't mean punishing yourself. Responsibility is not self-blame, it's self-ownership. Blame says, I failed because I'm not good enough. Responsibility says, I produced this result because of a specific decision, belief, or emotional reaction, and now I have the power to adjust it. Responsibility empowers you because it puts improvement within your control. Blame paralyzes you because it makes you feel powerless. The distinction is the difference between a trader who stays stuck for years and a trader who evolves quickly. Ultimately, responsibility is the doorway to psychological freedom in trading. It frees you from emotional dependence on outcomes. It frees you from the need to be right. It frees you from the endless cycle of frustration, regret, and self-doubt. It grounds your mindset in reality and strengthens your ability to stay aligned with probabilities, discipline, and your trading plan. With responsibility, trading stops being a battle against the market and becomes a process of refining your internal state, decision by decision, moment by moment, until your actions consistently reflect clarity instead of confusion, intention instead of impulse, and awareness instead of reaction.